The learning element is really what makes people stand out. I would spend as much as I could playing video games and then increasingly programming on my own. And it's the best model of innovation that as a humankind we have developed. The FOMO element is definitely a big element of the VC industry.
At Context Ventures, our podcast, Advancing VC, covers all things startup and venture capital, primarily how startups and venture capital are changing from the emerging manager perspective. We chat with venture capitalists, limited partners, and founders who are actively working at the frontiers of our industry and are advancing venture capital. Today, I'm honored to have as our guest Daniele Viappiani from GC1 Ventures. Daniele, thank you for joining us.
Thank you for having me.
Daniele, can you please share your journey from civil service to venture capital?
I get this question a lot because it's not like the most typical of career transitions, I guess, from going from civil service to venture capital. And I kind of have to do a little bit of a step back on why I did that and how that happened. And it's really, when I was growing up, I was really a geek. My spare time, really, I would spend as much as I could playing video games and then increasingly programming on my own. And my fun fact, my mom wanted to limit the time I and my twin brother actually would spend at the computer, and she wanted us to just have a half an hour at the computer a day. But I wasn't having that. I wanted to do more, and it's funny because my older brother tried to limit me by putting passwords on the computer and so on, and actually basically hacked into my family's computer so that I could play longer hours and use the computer more and so on. And I was really into that. And at the point, I thought maybe I would follow my older brother and do kind of computer engineering or computer science, but instead I decided to go in the civil service, and that's because I wanted to learn how government work, and that's why I decided to study economics. And I had probably a little bit of a kind of childish idea based on video games like SimCity or Civilization, where I was and confronted at the same time with the fact that in Italy a lot of things were not working. There were a lot of scandals, political scandals and stuff, and it was in Italy, at that time, we're talking about the 90s and then early 2000s, and it's if you were someone in kind of computer science, you would go work in the basement of a big company and tell all people how to turn on and off the computer. And I was that wasn't so appealing. And I was no, I want to learn how to fix problems and have an impact. And so that's why I studied economics, then I studied public policy in the UK, and I went to work for the UK government. And I worked on a variety of different policy areas. I worked on environmental, agricultural, and climate change policy. And then later on, as more and more the Silicon Valley was having more of an impact on the whole world, and the internet economy was booming. That's where I started to say, okay, I really want to go back into that technology world that I was always passionate about. And so that's where I basically pivoted on working on technology policy in the UK government. And then, even more so, I thought, well, what if I try to do the same thing again? When I went to the UK trying to learn public policy, I said, why don't I go to the Silicon Valley and learn, from there, how technology, how, startups and so on. I also always had a little bit of a dream of, creating a startup and so on, and decided to apply to do a master at the business school at Stanford, and that's what I did, tried to do startups, and then that's how I ended up in venture capital. And so, there was a series of pivots there. There was also maybe a bit of luck. Now I'm in venture capital.
I think there's so much attention paid to technology pivots. And I'm just thinking about, you were talking about gaming and computers as a child. I grew up with an Apple IIe, and then there's the Apple Mac, and then there's the Nintendo NES, and then the Game Boy. I remember when the Game Boy came out, I was just wow, technology is incredible. And then beyond that, obviously, there's the desktop laptops that keep improving, the 386, 486, 586, and then I'll stop soon, but like the internet comes around, then the iPhone. It's so cool how technology keeps pivoting and increasing, but I also, given your journey, feel like not enough people give themselves the liberty to make pivots themselves. And so now you're at GC1. Can you share more about GC1's, I believe it's a perpetual investment philosophy?
We, at GC1, we invest both in venture capital funds and directly into companies. And we have a solo LP, and so we are able to have that kind of patience and flexibility that maybe other institutional investors don't have a chance to do. I think it's great the fact that we invest both in venture capital funds and directly into companies. That allows us to have a great vantage point about the whole industry, because we are able to see, what different types of VC funds are doing, and we can have a portfolio of different startups.
In terms of investing in venture funds, what are some traits or hallmarks of successful venture funds?
It's interesting because I always make this metaphor of like the restaurant. I feel like VC funds kind of do similar things in a way, in the same way as to chefs at restaurants or even chefs at home kind of do something very similar. They might use similar techniques or similar ingredients. Like on a very basic level, the work they do is very similar. And the same applies to VC funds. Everybody is looking for companies, sourcing investment opportunities, selecting them, picking them, doing due diligence, and then try to add value. And I think in a nutshell, that's all that a VC fund does. So what I'm always trying to find is kind of the special sauces or special recipes, and trying to select what we think are the best VC fund managers at the moment, and also the ones that we think have a good chance of being the best VC fund managers of the future. And it's a bit of an art and a science, it's easier said than done, but yeah, we try to do it well.
So to extend the restaurant analogy, one time we did a walk and talk, and you had mentioned that you find that for venture funds that are fundraising, it's best to have people outside the line of the restaurant, rather than going into the restaurant and having it just be like a big space with very few people sitting down. Meaning, I think the metaphor is better to say you're going to raise less and raise more. Is that a good read?
Yeah. I think. I think that I don't want to overstretch the analogy, but I definitely made that point in the past. I think fund managers sometimes do the mistake of trying to raise too much capital, and whether it's like established ones or emerging fund managers, there's various reasons why you might want to or need to have a bigger fund. But at the same time, that of course creates all sorts of like consequences or implications for portfolio construction. But I think in terms of the fundraising process, I do think in terms of tactics, it's better to be the restaurant that maybe is small but has a line outside and everybody wants to be in that restaurant, as opposed to be a massive restaurant that looks empty inside, and then people kind of peek inside and they don't want to be there. And so I mean, I think for good or bad, the FOMO element is definitely a big element of the VC industry, but it's also one I think a fund manager has to be aware of. So my recommendation often to fund managers who are starting on, I recommend to kind of go for a smaller fund, especially as the fundraising environment for fund managers continues to be challenging. But yeah, I think people are a lot more conscious now. I think there's been different lessons being learned across the industry with, the so to say bubble kind of bursting a few years ago, or rather, the low zero kind of interest rate environment, and now with higher interest rates and still very few IPOs. Obviously the capital that goes into the VC industry is capped to some element, and therefore like that pushes funds at all sizes to have to kind of also be conscious of that.
I love the restaurant analogy, and I want to probably for a large part of our conversation talk about that. So on Sunday I read, or it was maybe the previous Sunday, a restaurant critic had went into the French Laundry, and this was in the San Francisco Chronicle. And I am curious, critics obviously inform people, but in the case of funds, LPs inform other LPs. How much, as an LP, do you talk to other LPs about, hey, how's this fund going, or what do you think about this fund? How much do the quote-unquote restaurant critics talk to each other?
They do. I mean, I think it's a, I was saying it's an art and a science, and I think the science element is looking at the numbers of a fund or a VC investor and looking at their track record, and in terms of TVPI, DPI, IRR, hit rate, and that to some extent is the science. The problem with that science, though, that is kind of limited evidence for VC, because you obviously don't have a guarantee that past performance, is a good proxy of future performance, and also it's actually a big time lag between when the investments are made and when the returns are really delivered to the limited partners and the investors. And ideally you want that kind of distributed kind of returns. But because of that long time lag, we're all looking at the kind of TPI, which is more like paper returns based on valuations that people have paid or think that might be kind of related to the performance of the company and their growth, but it's really a long time lag, and to that DPI and TVPI have those limitations, and so like everybody's using those numbers, but it gives you only a limited picture, and that's where like you have to complement that with obviously like an understanding of like the other kind of maybe more qualitative elements of that kind of sauce and special recipe, but you also do that by basically talking to other people and doing due diligence in terms of both talking to founders or other limited partners or other people that a fund manager has interacted with, totally talking to other LPs, whether it's you come across them at an AGM or at some dedicated VC kind of conference and so on. There's a few ones that many people try to go to. Like with these different bits of conversations and due diligence, you always get like a limited picture. And I think something like this happens also with like startups. Like the people who have invested tend to always be more optimistic and positive about it. And the people who passed on will tell you all the reason why they passed on. You always have to take this with a grain of salt because you're trying to come to your own decision and conclusion. You don't want to like effectively delegate your decision to someone else. And it's easier said than done, but like I always try to put that into kind of my mental framework about a GP. What am I evaluating and what evidence am I getting here?
There are certain venture funds that Beazer at Sapphire now calls franchise funds.
Yeah.
And the reason I bring this up is because when I think of restaurants, there are franchise restaurants. And I believe at GC1, you all look at both newer restaurants, growing restaurants, and franchise restaurants.
Yeah.
How do you decide between investing in, say, a newer restaurant / emerging manager or a franchise big fund?
Yeah, I mean, I guess we try to think about our portfolio construction as well, and we try to have a little bit of a balance between the different kind of buckets. Most people talk about emerging fund managers and established fund managers, with the idea being that after 3 vintages, you're an established one. I think that definition has a bit of a limitation because I'm not sure you're really established when you are 3 vintages, and so I like to call them more like establishing. And then, you have those funds instead who have been around for 20, 30, more years, so for a very long time. And I think it's a bit unfair to call them, some people call them legacy or find other, or super established. Some people say top tier, but then everybody wants to be top tier, so then it's So it's a bit more fuzzy, the definition there. But anyways, thinking about those kind of three buckets, emerging fund managers, establishing and established, we try to have a little bit of a balance between them. There's a complication, I guess, in portfolio construction where the established funds tend to be larger, and also they tend to be either multi-stage or later stage. You tend to have those kind of established funds kind of covering more of the kind of growth and late stage, but you do have some funds that are specialized only growth stage, and some funds that are slightly bigger and are more specialized early stage. But we try to be aware of that, but obviously smaller tickets for more emerging fund managers and larger tickets for the kind of more established fund managers. We actually do have another portfolio that we, so to say, co-manage, where we have only the super established, so to say, fund managers, and that's kind of just that. So we also have the, I guess, luxury to then have some funds that maybe kind of graduate to that for us. But yeah, in the main portfolio that that they manage and invest for, we try to have the balance between those three buckets. And of course, the underwriting looks a lot different for those different buckets. And the emerging fund managers, there's probably even more kind of subjectivity and more art, and then the established ones, there's a lot more looking at, the numbers. But there are also new challenges. And so you do want to make sure, or at least we try to make sure that established funds are not going too crazy with becoming too big too quickly, or we always have to kind of do a new underwriting with new vintages, because the fund might become larger and therefore also change strategy. We try to also with established funds or funds that have been around for a long time, you also start to think about maybe generational transition, and but even for the established funds, you're already starting to think, okay, well, how is the team growing? Who are the new people? What is their role? And what other maybe programs the fund is doing, and how do they treat exits? So there's more and more questions actually that are added to the analysis.
It's 2025. In 2021, there was an explosion of venture capital firms. 2025, it feels like there's a narrowing of venture capital firms. Has that made GC1 in your life easier in terms of the number of funds that you all need to see in order to feel like you have a good view of all three of those emerging, establishing, or established?
For us, it's actually been beneficial, because a lot with higher interest rates, a lot of institutional investors have to somewhat retreat or cap their exposure to venture capital, and also with the kind of reset of valuation, particularly in the growth stage and late stage. And that meant for us that basically we have more access, and a lot of GPs have sort of learned the lesson and kind of sought more LP diversification. And so that's been great access for us I would say, across the spectrum of emerging and established funds. So in a way, it's been an opportunity for us. The amount of emerging fund managers and VC funds, the way the industry is growing does sometimes, though, concern me a little bit, because I wonder whether it's sustainable in the long term. So, this obviously it's a power law industry, so not all emerging firms will be around in a few years. And the other aspect is that it does seem to make sense to be more exposed to seed and pre-seed and early stage and emerging fund managers, but there's also been less of a reset valuation there. And while investing earlier means that you have more scope over time, when you're growth late stage, if the valuation is not right, the only way forward is kind of a flat round or down round. But and so you have maybe more wiggle room when you're in the early stage, but at the same time, the valuations have not come down, so much. And so that's, and with AI, you are seeing some of these super big seed rounds for AI companies. And so like, it is something that try to, think about. And I think what that means sometimes for, underwriting emerging fund managers is like, what are they bringing to the table? What kind of recipe or lens do they have that is special? And are they just chasing hype, or do they know how to really find the best opportunities? But again, the challenge with our kind of industry is that like nobody really knows what's going to happen in the future, and it's going to take a long time to then know who was right and who was wrong.
So if venture capital firms are restaurants or chefs, you all not only participate in that in the sense of you all feed at those restaurants, but you all also do direct investing. So you all know a bit about what that's like. Can you talk about the different perspectives you view when it's doing a direct investment versus doing it through a fund?
When doing a direct investment, we try to do the same thing that everybody does. So like looking at the, how big can it be? How big is the market? And, how, what makes this team special? And, what insights do they have about the world? And, the kind of why now question as well as why them. And look at the numbers, the traction, the revenue, analyze that. And then we do some due diligence as well. I think a core element of what we do means that like we do kind of piggyback to some extent on the due diligence that maybe the VC fund managers in our portfolio have already done or are doing. And and already the fact that they are in the underlying portfolio for our funds, it means that there's already like a selection there. And then the other element of selection that happens is that we don't invest before Series A. Usually we're trying to kind of, as seed has become the new first institutional check, we started to like think about, well, can we invest also in seed? But normally the strategy is to invest from Series A or later stage. And so that reduces the risk for us. And that's really important because we are fairly concentrated in terms of the type of investments that we do directly. And therefore we, we cannot have the type of risk that maybe is involved in when a fund does, 50 or 100 or the kind of number of pre-seed and seed kind of investment. We invest from Series A, and we try to look for companies that are not going to disappear one day to the next.
Your background is very international. GC1's background is international, and you've written in the past about location-based barriers to investing. And I'm curious, what advice do you have to founders based outside of major VC hubs in terms of raising capital? My
job is investing in the US, and I'm, being in the Silicon Valley, I'm a little bit biased. So there are two things I would say there. And one is that I do think that building in the Silicon Valley is easier because there's more capital, there's more talent, and there's this amazing peer pressure that I actually noticed even when I was at Stanford. Like, when you're at Stanford and in this place and you're surrounded by entrepreneurs, it actually makes people who have never thought about being entrepreneurs, maybe I can be an entrepreneur. And that's an amazing kind of positive reinforcement, and it's a big part, I think, of why it's easier to build here. You're surrounded by people who are entrepreneurs. And instead, if you're an entrepreneur in maybe other countries I lived in, like, in Italy, or to be honest, even the UK, which is a relatively big tech hub in the world, you're surrounded by people who are not entrepreneurs, and you might, get a lot of challenge, whether it's your family or your friends or, people who don't understand what you're doing and so on. And so while you definitely can be an entrepreneur, I'm just saying it's harder. And there's a little bit of a self-selection where some of the best funders do come here, knowing that here is easier. But more and more there are great founders building great companies all over the world. And I think it's definitely doable. I think it's becoming easier in other places as well as, hubs grow and more people have the playbook. There's more capital, more, programs to help founders. So it's definitely possible to do it somewhere else. And there are some people who don't want to move here, or also like who might actually want to build a product for where they are. And if you think about that, it's the most important thing when building a business is really to create a product that people want, as YC famously say. And you know the users of where you live, so it's easier to have more user empathy if you know the users, because it's like the country where you grew up. So like I do think there's some founders that sometimes think, I have to go to the Silicon Valley to build, and I don't think that's true. I do think people can build somewhere else, and the rest of the world also needs apps and startups to make life easier, whether it's for business or consumers. I just think it's important for people to be aware of this and also be not naive about moving to the Silicon Valley. I hear sometimes founders who come here for a week and they say, I'm gonna raise a round, but it's not like, if you're not in the Silicon Valley, I think it's not easy to actually raise money from the Silicon Valley. And because of the geographical and kind of time difference primarily, and the investment approach the funds have here. And so I think people kind of have to choose where they live before doing the startup. You can't, and you should really be focused on building a startup based on some needs, some problem that you've identified, and not just trying to kind of optimize, where am I gonna be, and because then you're no longer thinking about building a startup and solving problems.
When you meet emerging managers or establishing funds and these franchise funds, what are some traits that cut across all three of those groups that make them stand out? Is it like a focus area? Is it persistence? Obviously, they've got to have great numbers, but what other are maybe some qualitative aspects of these firms that that you believe make them stand out?
I don't think there's like one unique profile. I think people come to success in different ways, and I think keep trying definitely. People who keep trying and people who keep doing, it's an important trait. I do think entrepreneurship is a skill, and a skill that you learn and you improve. And so it's when people think about serial entrepreneurs or whatever, of course there's an element of grit that everybody talks about, but I think there's an element of like learning. And so that element of like learning over time and doing different things is so important. And the people who keep learning, whether it's from failures or mistakes or changing things and so on, but yeah, like the learning element is really what make people stand out. And I think that's true both for emerging fund managers and for founders of startups. The truth is that also we're all trying to take shortcuts to make good decisions, and so where people studied and what they did before will play a role. But I think people are always kind of, I would say, judged in the present moment and what they're doing right now.
If I had to summarize it, it might be grit and curiosity.
Yeah.
Grit feels like it's persistence, and curiosity is like intellectual in some ways. And so having those two traits are critical. In terms of GC1, how do you all separate or think about, are there different teammates who do directs versus funds, or is it a team effort, or how do you all approach that?
There's two of us who are more on the lookout for new opportunities, and then there's we have a person whose sole job is helping portfolio companies directly, and then we have two people who are more on the back end, operational and administrative, which is there's a lot more than one would think to do in terms of like closing investments, reporting to our investor, and there's a lot of that. But yeah, we try to be a fairly lean team, but there's a lot that we are doing. and we all try to, help each other, and we all, to some extent, get involved to a bit of everything, and but also trying to kind of focus on our superpowers, so to say.
If 2021 was this time period, and it was, where there was a lot of money coming into venture and startups, 2025 being maybe you could call a period of reset, and even like secondary activity, where do you see the future of venture? Are you bullish? Are you a bit bearish? Or you think it's just going to take a lot more time for more IPOs to come, and more specifically IPOs that are priced higher than their last valuation?
In a way, I'm both bullish and bearish. I would say first why I think I'm bullish. I think that VC is a new industry that, was emerging maybe 30, 50 years ago. And now I think it's a real industry. And I think most, developed countries, at least, and possibly any country, will have a VC industry. That is really important because I think is the best model of innovation that as a humankind we have developed. So I don't think people realize that VC as a thing is an innovation, right? And it's a way we found to really spur innovation. And before we didn't have these, and innovation would often be someone paying someone to invent something, and it might be a government or a noble in the Middle Age or whatever,
or a big company.
Later on big companies, maybe in the Middle Age there weren't big companies. So I'm kind of, but in kind of the modern age, it's like companies paying and having an R&D budget, for example, and government having a, R&D, whether it's through universities or directly or some agency, and that model didn't always work. I mean, of course, it gave us a lot of innovation, but it was also very inefficient because it turns out that you don't know what you're inventing, and it's also not very motivating for the people who invent things when a company gets the result of that effort, or if it's very bureaucratic because governments have to make sure that you're not wasting the money, and so they put a lot of controls, but those controls make it really, really stiff innovation because you think you're inventing something and then you end up inventing something else. There's so many kind of examples of that in history. And then the other kind of model that was invented in the past was actually almost like a challenge. So say, okay, we're going to give this money to whoever invents this. And that has worked in the past and it continues to work now. I think if I'm not wrong, the way to basically we eventually arrived to watches and calculate time came through one such challenge, and the invention of meridians and so on. And there are some examples like that. But VC has become this new type of finance where we're basically saying to a founder, we give you money, we're on your side, and go invent something, and you have some time to do that. And it's an amazing kind of form of finance that is really spurring so much innovation. And that's a very long explanation to say why I think VC will continue to exist and will keep growing in every country. The reason why I'm also bearish is that, unfortunately, that the valuations have shown form for kind of growing a lot. And they are difficult to keep in check exactly because nobody really knows how much something is worth, and it can be worth so much. And because everybody in the industry is aware of the power law, they also don't want to miss out those companies that are going to be great and that people have found out some of those amazing innovations, they can be a good return even at a very high price. And there is very little to keep this in check. And so I am worried that there might be more corrections in the future. But it is a high risk kind of asset class, and so the people who are involved in this, know that there will be, potential losses in some of the investments.
A couple of fascinating things you said. One is around just how venture capital works, and it's very, from my perspective, a very measured investment that one's making, right? You're like, hey, go build this. Hopefully in the next year to 2 years, you'll have enough customers, great product to go raise again. And I feel like it's a measured form of financing.
Yeah.
And then the second point you mentioned around overvaluations, I think we're at maybe the peak of AI right now. And so that could be a reason why you feel these valuations are a little bit high now.
Yeah.
Another thing that I'm really curious about your take on is how efficient are the markets for private markets? And so like public markets, presumably, it's an efficient market.
Yeah.
I'm curious, do you think as you get closer to the pre-seed, it becomes more inefficient? Or do you think even pre-seed is a pretty efficient place because venture is growing?
What do you mean by efficiency?
Efficiency meaning that there's a large number of buyers and sellers, and there's transparency in terms of market pricing, and the market works very efficiently in terms of matching the best buyers, the best sellers with the right buyers.
Yeah, I mean, I would say that there's efficiency in terms of especially, in kind of US, Silicon Valley kind of VC ecosystem, there's enough, money to play, and there's, very savvy investors, and so in that sense is efficient. But it's just the way VC is designed. Valuations are not based on so in standard finance, you basically have a cash flow model, and that gives you the valuation, the expected cash flow of a company. And so if you looked at a startup from a kind of classic finance perspective, their value would potentially be zero or negative, because their cash flow might actually be negative for the foreseeable future. We're all trying to become smart about based the future cash flow based on how much it's going to grow and how quickly it's going to grow, but it is a new form of finance. And so I think there's that inherent kind of complexity where nobody really knows how much a company is worth. It's more in a way it makes more sense as a portfolio level, because you don't know a single company how much it was going to be worth, but you're hoping that you know how much your portfolio as a whole is going to be worth. I just don't think that any something that we've cracked in terms of how can we kind of be aware of this kind of maybe kind of sort of valuation spirals a little bit. But obviously AI is a very exciting innovation that I think is going to generate a lot of returns and spur a lot of new innovation as well. And so sometimes those valuations may be justified, but I also think it's important to be cautious a little bit, and and we try to be in our investments, and but yeah, it's easier said than done.
What are potential deal breakers for restaurants you go meet and visit? Is it the chef's temperament? Is it the setup, meaning the LPA terms? What are certain things that you're just hey, these are things that we will just walk away from?
It's interesting, isn't it? Because if you keep the restaurant metaphor, the things that will really make you walk out are things that you probably don't see. You don't really see what's going on in the kitchen. You trust them to be doing, well and clean and whatever. And that's, I guess, why there's some regulation and so on. But maybe those are the things that will make you really walk out. And then the other things that maybe will make you really walk out of a restaurant is the service. And so there's always a little bit of a service element. Do they treat you well? Do they treat each other well, in the restaurant? Do they treat other customers and the employees well? So those are the things that will really make you walk out. But you also don't really see the innings of how they work and so on, right? And obviously you're looking for great food and great presentation and whatever, but and sometimes actually even the presentation, maybe we're overstretching the analogy here, but sometimes there are some kind of restaurants where you're not really going for the presentation, you're going for that hot dog or like
The protein.
Yeah, just best burger. I just don't care about how you give it to me, right?
This has been a really fun conversation. I want to now move into rapid fire questions. And you're going to laugh at the first rapid fire question, but what is your favorite restaurants? Real restaurants.
Oh my God.
Yes. And they can be.
I haven't
like, some
been going to
love,
a lot of restaurants lately.
Some people love In-N-Out, right? Like, and that's. But like some people, like our apprentices just went to Super Duper. But like, what are the places that you like?
Gosh, I have to. It's difficult to pick, because I do also like variety. Which
how about any franchises? Are you a big fan of, say, In-N-Out or Super Duper, or no? It's like.
I do like In-N-Out. There's just something a little bit naughty about like how customized it can be. About like I went the other day and I was like, oh, can I have extra tomato? And like there's something a little bit naughty about like having. There are few ingredients, but like I actually a restaurant that I really like in San Francisco is La Ciccia, which is a Sardinian restaurant, and everybody always thinks about pizza when they think about Italian restaurants, and I really like that they offer Sardinian food because Italy has so many like different cuisines that people don't know as much about, and I love Sardinian food.
I'm gonna check that place out. Favorite movies?
Favorite movies? The first one that came to mind was Matrix. I'm a big science fiction and fantasy kind of fan, and it's maybe it was primed to think about technology, but yeah, Matrix, Lord of the Rings. I love the Dune movie by Denis Villeneuve. I think it's made it might actually for me be even better than Matrix. Actually, now that I think about it, I love Dune.
Great films. Favorite books?
This is not as rapid fire as you thought it will be. The thing is that I've already used Lord of the Rings for movies, but like I would say for me, Lord of the Rings growing up was such an amazing read, and I really loved Lord of the Rings and The Hobbit by Tolkien. I did read Dune as well, so that's double. Isaac Asimov's books, The Foundation Cycle. Oh, that's so good. And I'll tell you what I like particularly about Dune and Lord of the Rings and The Foundation Cycle is that even though they're talking about things that are really fantasy and science fiction and so on, it feels like it could be real. It feels like there are like principles in that word. There are things that there is coherence. And I really like that. It's both fantastic, but also internally coherent.
Universal stories and truths about humanity. Favorite travel spots?
Travel spot? The thing is that I always like to go to new places, but this might be a little bit cheesy, but like there's something about going back to Italy now that I don't live in Italy anymore, and places where maybe I went as a child or as a teenager, like Sicily as well actually, but I was gonna say Sardinia and Liguria. I went a lot as a child, and for me they are just amazing.
It feels like you have an affinity to islands. Sardinia, Sicily.
Oh, Liguria is not an island though.
My bad.
Liguria is like the coast in north west Italy, and I do love the sea, and it's also about food. There's amazing food in Liguria. That's where focaccia comes from, and Sardinia, as I said earlier, I love the food from Sardinia, and there's also something about like the history there, like in Liguria it used to be like this big like a republic. Genoa was a big republic, a maritime republic, and they built all these really colorful houses. And so like the towns there are so pretty on these little mountains or hills in front of the sea. And similarly in Sardinia as well, like the old towns are a bit like that as well.
Daniele, this episode has made me extremely hungry. I've never thought more about food in this past hour, but at the same time talking about venture capital and startups. Really appreciate you taking the time to chat, and wishing you and the team at GC1 the very best.
Thank you. It's been a pleasure. Thank you so much for having me.
Thank you.